into that today, obviously. I hope everybody's having a great day. It is September 25th. It is AI Day. Very important day in a boy's life. All right. So as we go through today, talking about momentum, a little bit of concerns. Today we'll talk about the runner at 9 o'clock. And again, it is all about AI. Every day we're going to do a little bit of a preview today in why following these trends and these stories is so critical, because in this environment, it is sucking the oxygen out of everything. All right. Good morning, Randy. Good morning, Lyndon, Eric, Doji, Eric in Northport. Good to see you. Tall Tex as well. Why are you here? Well, on a day like today, a little bit of questions about what's going to happen with TikTok. Oracle's getting beaten up. Palantir's getting beaten up a little bit today. We're seeing some weakness in names like Netflix. We want to talk about what's worth engaging, and we're starting to get into that environment now where weakness creates more weakness. Now, I'm going to talk a little bit about something that the journalists seem to be paying attention to finally, and a handful of the analysts out there in the world of finance. But we'll talk about the top stocks breaking out, breaking down. We'll do the runner at 9 o'clock. But we start, as always, with momentum. We are -7 on intraday. Pretty interesting to see this. Good morning, Secret Agent Charlie. Thanks for joining us. Rodney, John, Les, Jimmy, and Stewie. Good to see you. Don't recognize Stewie. Arshosky, good to see you. So we take the number of stocks in breakout conditions, subtract the number of stocks in breakdown conditions, and then based on that, we analyze whether or not this market is breaking under key momentum levels. We see the SPY dropping under that 8. But here's the other thing. It's that FNGD. FNGD. Pushing above toward that 20-day SMA. There will be a reverse split on this soon. I believe it's going to go to 50. So we'll keep a very close eye on it. But the core thing here is if we start to see a break move on that 8 and that 20-day moving average, what is in store for this market? Now, we have the reverse repo issue that we've talked about in the past. And we also just have, look, we were at all-time highs. We're concerned about leverage. We're seeing money flow in from every single place in the world all at once. Profit taking is part of the game, but there is these days where you start to sense, okay, there's a little bit something off. Now, Jerome Powell coming out the other day and saying stock valuations were elevated. It's unusual when the Fed chair does that. It just is unusual. But as we're going to point out, really at the core of what this is about liquidity and about concerns heading into October and into this fourth quarter, and questions about whether or not this economy is going to remain strong, what the job numbers look like. We have a job report coming out next week, and the questions are still built around the Fed's inability to get inflation down to 2%, concerns about unemployment, concerns about those big numbers, those huge changes that we have seen. 900,000 jobs disappearing into thin air, 800,000 from the year before. So if you feel like things are off, and I think that that's one of the things that is always very difficult for financial traders, investors, they know something's up. They know the underlying economy isn't as strong. They know that a lot of this is built on the back of just a lot of money sloshing around. But what we're looking for and what we're trying to understand is what are the conditions, what are the clues that we may have that risk-off event that takes a couple percentage points off the S&P 500. Now, Brandon does a very good job at that following, Ghost Prince. We have a lot of people constantly. Don's always looking to short. We know that. But sometimes it can be a process of a couple of days where the market continues to move upward because everybody's climbing into those FANG stocks. So what we're looking for is when it starts to go away, when all of that leverage in the system is potentially threatened. So we are going to be watching this very closely as it approaches its 20-day moving average. If we move over the 50-day moving average, that is going to be the time to be very aggressive to short toward the downside and look for a 4, 5, 6% downturn in the S&P 500 over a relatively short duration of time. Now, we're not there yet. We're going to be patient, but this is kind of how it all operates, right? You're saying it right now, SOXS, same thing, right? The semiconductor stocks are approaching these key levels. Very important. TECL, TECS, right? To the technology stocks. Weakness. What did we talk about? FAZ, the bearish financials, showing, again, concerns about the regional banking space and concerns about the reserves in the financial system. And if that breaks, that's where the Fed is going to have to step in. And how do we know when the Fed is going to step in? Well, we follow the insiders. Because when insiders are aggressively buying in the aggregate, executives buying their own stock, all of the amount of money that they spend on fiscal and monetary policy consulting pays off. They've called the bottom of every effective major, but also short-term downturn going back to 2008. So we'll continue to dig into that. The big story still remains the fact that the S&P 500 is near record highs, but those concerns are rising. We see it for what it is. We know valuations are stretched. The Federal Reserve talking about it. We have persistent inflation. We have tariffs. We have high valuations. And I keep hearing all this stuff about valuations, right? Oh, we haven't been at these levels since the dot-com bubble. We know that. We also are at 3.3 times sales on the S&P 500. That's never happened, right? The thing about this is this can remain irrational to the upside much, much longer than the shorts can bear. And it's the same thing in downturns as well. We saw that in 2022. The market continued to sell off. It would hit oversold, then it would spike again on short covering combined with, basically just algos buying the dip. We would hit oversold and we would sell right back off. Now, we're not in that pattern yet. That's likely to come next year, following year. That's where we get to the liquidity cycle. But again, watching the SPY, watching the Qs, trading the S&P 500. Now, I'm going to wait for the market to open because I don't want to buy puts. This is very important. This is volume weighted average price of the SPY or S&P 500 ETF. You see VWAP, blue line. You see the market selling off pre-market. But here's the issue, as I've noted time and time again. The algos continue to step in and bid if we hit that fourth deviation line. One of the other problems, though, is that if funds are selling, they're not going to sell aggressively in volume. They're going to try to ensure that they keep everything in this second deviation band. You move into that third band, as Stanley Druckenmiller pointed out in 2018, these algos are stepping in and bidding, and then all of a sudden, for reasons that nobody can comprehend, we're back at 661 within 3 hours. This is what is conflicting and confusing a lot of people. So I don't want to try to short the SPY if we get down here. I'm hoping that we get an institutional bounce today up to around that 658 level. And then at that point, I'm buying the 658, possibly for tomorrow, most likely next Friday. And then I would sell right down at the 20-day moving average. I'm looking for a move from the 8 to the 20. And that's it, down to 655. That's the trade. And again, by buying the 658 or 659 and selling the 655, if this market does reverse, the put that I sold to the downside provides a little bit of cushion in case this market does move higher. So I'm trying to reduce my risk. I'm defining my short position. I know exactly what my position would be, and I'm moving out of the way if the S&P 500 does recover. But again, what we're looking for is a retest of that 20-day moving average, not 650, not 658, not 568, 658. Forgive me if I said 568. So right at the 8, sell at the 50-day. But only, again, you want to not do this if we end up down here to start the day, because that's where those reversals will come, and that can wipe out your position instantly because of the nature of the algorithms. All right, on top of this, this is a big chart. I get it, or a big slide. This is what I was talking about with the fact that journalists seem to be getting it. Stock market frothiness might just be the new normal. Welcome to the party, pal. This has been like this since 2008. Where have you been? Well, Bank of America analysts saying the index has changed significantly since the 80s. What are we looking for the SPY 658 retest? It's volume weighted average price, VWAP. So you're looking for hopefully a move back here to start the day, buying the 658 and selling down at the 655 level, maybe even 654. I'm not trying to short down here. I'm trying to wait for optimal conditions, and that's back here at volume weighted average price. Okay, the index has changed significantly since the 80s, 90s, and 2000s. Perhaps we should anchor to today's multiples as the new normal rather than expecting mean reversion to a bygone era. No. The index changed because of passive investing, and it changed because of liquidity. So they're talking about statistically expensive levels. The analysts outline the case for why the index merits a premium. The S&P 500 has a lower debt-to-equity ratio than in prior decades. Earnings volatility has decreased, and major companies have fewer assets, major labor needs, and lower costs. And efficiency gains can come from deregulation and AI. It could be that, or it could just be all the money printing. It could just be the fact that global liquidity is at an all-time high, and that every single time that the Federal Reserve engages in quantitative easing or quantitative support, it paradoxically sucks money back into the United States. I don't know how people aren't getting this. I understand if people had CFAs and they got an MBA, but come on. The pattern changed because of passive investing. There is no price discovery left. We are engaging in an environment that is fueled by liquidity and leverage. No red ticks are allowed in this environment, right? Exactly. It really blows my mind because it really is that simple. This is Occam's razor. The easiest and most logical explanation is the answer. Global investors are flocking back to U.S. equities. Well, yes, they're chasing premium. And they're also, remember, we were 33% of the global index 10, 15 years ago. We're 70% now. Why? Because when we engage in QE and when we have so many names like NVIDIA and Apple and Amazon, and they're all connected to these ETFs, price discovery's gone. And the markets did fundamentally shift because, again, we engaged in new types of monetary and fiscal support that didn't exist before 2008. We didn't have a reverse repo market. We didn't have, rehypothecation with no haircuts. This is all about managing the debt of the United States and finding creative ways to ensure that we can engage in fiscal repression on our currency, on our debt. And there is a direct relationship between the M2 and inflation, and there is a direct relationship between global liquidity and global equity prices. That's it. SPY, NVIDIA, Apple, Microsoft, all these names will continue to have these moves that might be a 50, 60, 70% downturn during leverage leaving system. And then when there's accommodation, a stock like NVIDIA, a stock like Apple goes up 100% in 6 months. Same as it ever was. Pre-market weakness, Intel, Costco are back in focus again. Futures pointing lower after that strong rally. Intel's exploring an Apple investment partnership. Costco reporting earnings. And the government shutdown risks are also adding uncertainty. And remember, government shutdown equals concerns about debt, concerns about refinancing, concerns about, stability of the underlying economy. Intel, Apple, Costco, and the SPY, all in focus. Keep that in mind. 9 o'clock. That means it's time for the runner. And look, the momentum remains back in the lithium space. No doubt about it. right? We had the deal, U.S. buying into LAC, Lithium Americas. Well, ALB has this same element to it. And it's back above its 20 and back above its 8. And I like this name for the long term because there's a couple of things that I want to remind people. One, it's not necessarily just about the fact that the United States needs electricity, right? The battery storage component of this is monstrous. This is where Tesla is going to be moving. It's going to be in the AI and the battery space. ALB is a backbone company for this. But I do want to point something out. We're 1 year from an election. We're 3 years from a national one. And the pendulums do swing back. And the expectation around EV, if they continue to get cheaper, they continue to showcase improvements in battery storage, it's going to swing back. And ALB has been a bit of a momentum stock in the last year, year and a half. This traced kind of the performance of what happened with Tesla, ALB bottoming out back at that $53 level. But this is one of those names that the way that it's moving, the way that it's kind of popping a little bit today, I'm looking at selling a spread on ALB. I'm looking at trying to buy this stock at a lower price because of the government involvement now in the lithium space. So what I would be looking at in this environment would be something like the $70, probably the $65 put in November, and then buying the 60. And I'm going to show you what the math looks like on this. I know it's the ads. Don's already yelling. I can feel it. He's mad. Look at that. Who wants SRV treatment? That sounds awful. All right. 435 to make 15% on ALB, 85% probability of profit. We're going to book this stock. We're going to book this trade today. We're going to write it down for when the market opens. I'm going to get a little piece of paper out. And it's the ALB November 21 65.60 spread, looking for around 65 cents to 70, so $65, 435 to make 65. And again, trying to make 15% on a stock that I want to buy. Charles Schwab, got Charles Schwab ads. All right. IPI, Intrepid. So this is a name that I haven't seen in a while. Potash. But again, commodities, very strong. Very strong move upward. You have this move here on that 50-day moving average currently at 30.54. Cheap stock historically, but not good. Income, ugly. Enterprise value, lower than market cap. Yikes. Ugh. Anyway, cheap stock, 82 cents on the dollar on book, EV to EBITDA at 666 right now. So one of those names just trying to follow the momentum. If we can hold above the 30, 40. So over here, 29. Buying the stock and setting a stop at around $29. Right? And MLI. Mueller Industries. This is on very strong momentum, and we have to be a little cautious about this one because this can trade sideways a lot. But metal fabrication here, very strong momentum move that we've seen. If we get back down to this 20 and this market does figure its sweet self out, then I will be looking to bid here at 97.96 on a retest of that 20-day moving average. So why not do a cash secured put? Because I don't want to utilize that much leverage. I don't want to use that much leverage. Or forgive me, margin. Right? What's the difference between the two? This is a very good question. But I can actually, and to say that it's conservative, absolutely not. Because once again, let's take a look at this real quick. Cash secured put. 82, right? So let's say that we go out to November and we sold the 70, just hypothetically, right? It would cost you, you would need $6,732 in margin. 282, 286 is what you could make. 80% probability of profit. Now, why does that matter? 4% return is what you're looking at. Again, $6,732. If I do a spread, the math changes a lot. Out to November, I'm just going to do the hypothetical 65 and 70 and very wide spread at the moment, but I'm just showing you the math behind this. Okay. 378 to make 122. Remember, I was going to have to put up 67.32 to make 268. I can now put up 756 to make the exact same amount. Two spreads, 32% return, 80% probability of profit. So rather than putting up 6,732 in margin to make 4%, I put up 756 to make the exact same number. Well, just a little bit less, right? 244. 244 against 268. And the probability is basically the same. I have no idea what that means, hash fight. All right. On the other side, RXO. Weakness. Oof. Weakness. Yeah, I'll pull up this SPX real quick. Still waiting on this to load. It's weird. Don't tell me. Don't tell me that I lost it. Don't tell me that they got rid of the SPX VWAP. Oh, I would be heartbroken if that happened. Oh, okay, there we go. Whew. Deep breath, everybody. Oof, that could have been awful. All right, as remember, we're always looking for the SPX to move down into that fourth deviation line, and that's where we're looking for a reversion. We turn over to the SPY and buy whatever is in the money and set a tight stop. And yesterday, that would have lost. But as we've seen time and time again, here's a move into the fifth deviation. Happened the other day on Tuesday. And a little bit of a pop, not a big one, but you could do a lot if you stay in the money on the SPY, looking for a $1 or $2 move in a very short period of time. KKR. This is under a lot of pressure, as are all of the alternatives. And I said yesterday, what is this telling us? And I don't know what it is yet, but private equity and private capital have been beaten up pretty badly in the last couple of days. And it's not just KKR, it's also things like FSCO, which is one of my favorite things in the world to own. And it gets beaten up during these liquidity events. But this has fallen under key moving averages. We saw ARCC, my favorite business development corporation, getting trounced. So there's something off. There's something off in the liquidity situation right now. We don't know what it is, but the weakness that we are seeing in these financial assets is problematic. Now at 160, 136, I go straight at that 140 put right now and just look for downside and stay in the money and look to try to get a possible retest of the 130, maybe even lower down here at that 128.90 level. KKR, a lot of these names are under a lot of pressure, and it really has not been discussed. It's just one of those things that you wake up one day and you go, wait a minute, how the hell did that happen? Keep a very close eye on the DPST, which is the Regional Banking Triple Bull ETF, pushing around that 50-day EMA. We get under that 50, there's something wrong. KRE, same thing. Regional banks, a move down to that 63.14. We move under there, same thing. Same thing. So, weakness in the financials has been pretty pronounced the last couple of days. You have to be on top of this. You have to be very, very cautious, and you have to keep your head on a swivel in this environment, because right now looking across all the sectors. It's the cyclicals, it's the defensives, and it's the financials that are weakening. We're seeing more weakness now in tech and industrials as well, in addition to real estate. We'll be watching real estate over the next couple of days as well. All right, so BBWI and Anna, Netflix is weak as well. But again, Netflix doesn't stay, these things don't stay weak for a pronounced period of time. But we're under these key moving averages right now on Netflix, so a possible move down to 1150 is where I would be trying to move toward. AURA, RO Bio. Did I say that? Anna. Who even? Anna SA. Healthcare in Luxembourg. Why not? Why not? Buy the stock 664. Stop. Looking for potential momentum run here. Positive here on that RSI. This is very strong price momentum. Very strong price momentum on RSI and MFI. So a test and a stop back at the 646 level. Look for continued strength here. There's not a lot left in this environment. There really is not a lot left. Bath and Body Works, we're not anywhere yet. Looks like we're moving back under that key moving average. I would typically be going to the upside looking for a move back toward this 2757 level. We will have to look at the ghost print scanner to see if anything pops up on BBWI. But you're either going back to 25 or you're going back to 2748 and you trade around it. All right. Private equity is supposed to return capital back in a Ponzi scheme-like mechanism. Well, that's uplifting. All right. So today, 2 o'clock, I'm going to be talking about AI. And once again, I walked through this yesterday and I said, look, the Goldman Sachs AI bucket of 109 stocks is worth $29.5 trillion. The U.S. economy is $31 trillion. The average American is not getting wealthy on AI. They are actually in the crosshairs of AI. Meanwhile, Wall Street continuing to just blow the doors off. And I've said before, in the history of the world, when you have innovations, what are the biggest innovations in human history? Coinage, steam engine, railroads, traditional banking, the internet. All of those things took years to implement. It took the internet 20 years on infrastructure alone, right? The internet was considered to be the greatest thing in the history of the world back in the 1990s. However, we did not have the T1 infrastructure. We did not have the ability to reach out to rural areas. It took a lot of time. It was very powerful, but it wasn't very fast in terms of the implementation. Well, AI is not like that. AI is going to continue to sweep through as it has over the last 18 months for at least the next 2 years. And the returns with the expanding liquidity right now are monstrous. Yeah, we might have a short-term downturn, but hey, more QE, more money pouring back into these top stocks in the S&P 500. And you're seeing the headlines every single day. Are they hard stops or just alerts, soft stops? They're hard stops. Hard stops. AR startup Modular just raised another $250 million, the valuation at $1.6 billion. We've never in the history of the world seen companies making these valuations of $1 billion and becoming these unicorns as fast as they are. You go back and you look at companies like Netflix and you go back to the companies that were part of the .com run. They did not get to this level this fast. This has created more billionaires faster than ever, and it will continue to do so. And you need to be aware of these headlines and these stories every single day, because it's not just the big names at the top. Everything is built. The infrastructure is built. The utilities are aligned with this. This is a $30 trillion trend. It's nothing like it. So when you look at platforms running on these AI apps with hardware, avoiding to lock in, these smaller names, right? They're the ones that are servicing the big guys, the AMDs, the NVIDIAs, the Amazons, the Oracles. But all of them will continue to benefit from the expansion of this ecosystem over time. OpenAI has now moved into more data centers, expanding that Stargate data centers. New project in Abilene, Texas, 5 more planned. And what do you think the electricity is going to go to? Do you think it's going to go to the middle class, or do you think it's going to be prioritized? In an economy, and this is a very important argument here, this economy needs to grow its way out of its debt. And what some people believe the last great hope is artificial intelligence to do it. That the efficiency gains are so monstrous that they have the capacity to help us escape from our debt. Now, that is a very profound argument, but they are prioritizing the electricity and they are prioritizing the chips, and we are in the middle of a massive arms race. Massive arms race right now. A great analogy of the wave rolling over and surfing right now. Yeah, that's the entire premise of capital waves, right? The idea that you need to constantly watch the beach. You have to constantly watch the insiders, because the insiders are the locals of the financials of the financial system. And if they're not in the water, why are you? Right? But these are like multi-billion-dollar deals that are happening under everybody's focus. People are focusing on Conagra and all of these other, companies that are tied to, interest rate policy. No. The money is up top. It's in the open AI space. It's in Google. It's in Tesla. And it's going to be here the next 18 months. Alibaba, again, we're in an arms race with China. They increased their spending to $53 billion. They just unveiled. This is just today. These headlines are just today. And all of this stuff impacts everything. They're expanding their investment across the AI stack. Their stock ripping, rolling. Alibaba continuing to move higher. Strong momentum. I mean, that is an AI move right there. That is a $50 move in September. And it is heavily driven by 2 things. One, AI, and secondly, Chinese support at their central banking level. AI fueling robo-advisory growth. Interesting point happened the other day. They were talking about the fact that AI has now surpassed any one human at the CFA level, CFA 3. And that they're writing better. It's writing better essays, and it's grading the CFA levels harder. And the question now is, how much will AI drive the robo-advising and, of course, the passive investing space in the future? And what role does the traditional RIA have in an environment where AI is completely and totally blowing the doors off of traditional CFAs? Which is considered the Marines of finance. It is one of the hardest tests in the world, CFA 3. It's extremely difficult. And how does this impact companies like Schwab and Hood and Morgan Stanley and BlackRock and all the traditional banks? There's regulatory concerns. There's risk concerns. But again, the expectation is that this market is going to increase by 600% by 2029. And then you have cybersecurity, also critical, also AI driven. This is exponential. This might be the last big innovation in the history of the world outside if we somehow figure out teleportation and space travel. This is going to drive everything. So PANW and Crowd and Microsoft and Google, government challenges, the ability for government to actually stay on top of this stuff. The role of CISOs in the future and how they're going to manage large infrastructure systems. There is billions and billions, if not trillions of dollars at stake right now. And that's why we're digging into this today. 2 o'clock, the AI Freedom System. We're going to do a deep dive into AI. We're going to talk exclusively about the core stock, the one stock that you need to master, and how that is impacting everything else in this ecosystem. So join us today, 2 o'clock. Click the link. Make sure you get your ringside seat. It is 9:20. I thank you guys for taking the time to join me every single morning. I hope you have a great day, and I will see everyone from 2 o'clock to 4 o'clock today in the link. Have a great day. Don's coming up. Take care.